Good morning, students. Welcome back. So today we'll continue our discussion on this AS27, which is about joint ventures. In the previous session, we talked about this particular accounting standard. So let's do a quick recap. Okay. Now, can you tell me what do you mean by joint ventures? Over to you. What do you mean by joint ventures? Quickly. What is your understanding around joint ventures? Yeah. So when you say joint venture, we discuss certain features which are always there in respect of a joint venture. Remember? Maybe we can just start with that part first of all. Good. So Tambeshwari has shared. So she is saying when there are two or more parties. Okay, great. Sanya says when they undertake some activity through a contract. So means the second condition is when there is a contract. Okay, so two or more parties having a contract. So that's what Hardik also says. Great. Ajay says, and when through this contract they have joint control, means the decision making will be unanimous. Okay. Yeah. So that is what we understand by joint venture. Okay. I can see the same response from Nitin and Bhumika. Great. Now, in relation to joint venture, we can say that two or more parties are coming together. Why? Because they have some shared objective in terms of carrying out some operations, in terms of some business requirement. Yes or no? For which they will pool resources. Now, those resources could be anything. Those resources could be the funds, those resources could be assets, those resources could be the expertise in terms of running the business, carrying out certain activities. Yes or no? So it could be in relation to anything. Now, again, depending on as to what is going to be the purpose, what is going to be the sharing of resources, we talked about three types of joint ventures. Yes or no? Yeah, so we discussed that once again, depending on the type of structuring which will be there under joint ventures, there are three types of joint ventures which are possible. So, can you name those three types of joint ventures? Over to you. What are the three types of joint ventures? Great. Nitin says jointly controlled operations, jointly controlled entities, jointly controlled assets. Very good. Same is the response from Hardik. Good. Yeah. Then I think Anil has the same response. Very good. Great. Tambeshri as well. Very good. All right. So now, so these are the three types of joint ventures which are possible. Correct? Jointly controlled operations, jointly controlled assets, jointly controlled entities. Okay. Now, as regards these types of JVs which are possible, the accounting requirements could be different. Okay. Now, because the accounting requirements are different, so that's why one can say that in relation to JCO, for example, JCA or JCE, every time whenever you will get into the assessment of JV, means every time when you will assess whether a particular investment is JV or not, additionally you will also be required to assess whether that JV is JCO, JCA or JC. Yes or no? Yeah. Okay. Then we also discussed about JCO. Yes or no? We also discussed about JCO. We understood as to what do you do in case of JCO. So can you help me understand about jointly controlled operations? Over to you. So what do you have in case of jointly controlled operations? Over to you, quickly. What is the understanding that we have in relation to jointly controlled operations? Anil says, sir, most of the features of these ventures are same while identifying. Okay. What about others? Tambeshwari says JCOs have their own separate business. Okay. Hardik says they will pool resources and all the income goes to their personal. So by personal, you can say their own accounts. Okay. Instead of personal, you should say own accounts because personal could be more of personal. Huh? Okay. Ajay says when there is no separate legal entity. Okay. Ragini says in JCO, each venturer has his own separate business. Okay, Nitin says it's all about pooling of resources. Okay, great. Now, let's try to understand some of the points around JV first of all. I think one of the point around JV which is very very important for you to understand. So let's suppose there are two companies. Though we talked about it, but still it's better you understand this. Let's suppose there are two companies, A Limited and B Limited. So can they create a JV? Tell me. Can they create a JV? The answer is yes. Okay, Bhumika says yes. Very good. Now let's suppose they create a JV. Okay, and this is JV Limited. Let's suppose this is JV Limited. Okay, now in this case, if you talk about A Limited, it's a company. So A Limited has its own business. Okay. Similarly, B Limited has its own business. Yeah. So both these companies were already having their own businesses. Yeah. So it's not necessary that A Limited and B Limited will not have businesses and therefore they will create JV Limited. Understood? Yeah. And I'm not talking about a JCO right now. I'm just talking about any JV right now. Okay. Now, just because there is a JCO, to make a statement that in case of a JCO, A will have its own business, B will have its own business, will not be appropriate. Why? Because in case of a JV, it can always be there. Understood? Yeah, it can always be there. Right? Clear on this? Everyone? Yeah? Okay. So that is something which you can always see in case of a JV. Okay. Yeah. And let me just again say that this part that we have discussed is in relation to any joint venture. Okay. So this is about any type of joint venture. Yeah. Now, for a JCO, let us do a quick recap because we are also going to look at its accounting requirements now. For a JCO, what do you see additionally? In case of JCO, say there are three parties. A Limited, let's suppose it's B Limited, and I think in our exam to come together, or maybe three persons want to come together, whatever be the case. Yeah. So what they can do is they can create a consortium, or you can say they can set up their business. Okay. In which case, what A may do is A may provide some resources to this business. Resources could be in the form of some assets, funds, or maybe the operational part management. Yeah, so the management of the operations. The same thing can be done by B, same thing can be done by C. And the understanding between three parties is what? That they do not want to create a separate legal entity. Okay. So it's not been created as a legal company, for example. Okay. That has not been created. And in this business, okay, in this business, whatever portion belongs to A, in terms of everything, in terms of profits, losses, revenues, liabilities, assets, yeah. So, of course, those will be identified because if they have a contractual arrangement, so they will always keep it identified. So, what A does is, let's suppose this is the share of A. Now, how is this share recorded? A will record this share in its own books. Similarly, let's suppose this is the share of B. So B will record this share in its own books. Let's suppose this is the share of C. So C will record this portion in its own books. It's not personal, it's own books. Yeah. So now, as far as this business is concerned, so if you look at this business, is there anything which is unrecorded as far as this business is concerned? Tell me. Tell me. Is there anything which is not recorded? Hardik says expenses. No, the expenses again, they will also be taken up by the respective parties. Huh? When you are saying that A will take up, B will take up, C will take up. So they will also take up everything. Expenses, income, assets, liabilities, anything which is there. Huh? So now in this case, therefore, Bhavna says business transactions. No, so what do you mean by business transactions? Business transaction will take the form of accounting entries, basis which you'll have what? Income, expense, asset, liability, which is taken up. Yes or no? Yeah. Anil says A Limited individually is a separate legal entity. Yes, of course. Kasak says profits. No, the profits are also taken up by them. Sanya says share capital. There's no share capital because it's not a company. It's not a company. Ragini says they do have a contract. Yes, they do. Yes, they have a contract. That's why it's a JV. Okay, so we are talking about a JV right now. Hardik says intercompany transaction. So what do you mean by intercompany transaction? So it's a single business. We are talking about this business, huh? In this business, will there be anything which is unrecorded? Tell me. Larry says ownership. So, what do you mean by taking up ownership? Huh? So, ownership will continue to remain. I'm just saying that in respect of this business, which these three parties are collectively doing, when it comes to any transactions of this business, any assets, liabilities, any income, expenses, if those are already recorded by A, B, and C respectively, so will there be anything which gets left? Yeah, so I think you have thought about everything, but there's nothing which is left. Yes or no? Yes or no? And who has recorded that already? All of these ventures. So they have recorded that. Yeah. And they have recorded their respective shares. Yeah. So they have recorded their respective shares. A, B, C, they are recording their respective shares. Yeah. Therefore, in this situation, when this recording is already done by A, B, C in their respective books, so should A Limited or B Limited or C Limited also prepare their CFS to consolidate this business? Tell me, should they do this? Tell me. Hardik says no. Yeah, Dilip says no. Neeru says no. Why? Because it's already captured by them, it's already recorded by them. Yeah, and this is what you call as a JCO. Okay, this is what you call as a JCO. Clear? Everyone clear on this? Yeah. So this is what you find in case of a JCO. Now what we will do is we will look at one example, and in this example we'll try to understand this accounting. Okay, the same accounting that we just talked about, we'll try to understand that in more detail. Okay, moving, let's take up this example. This question one we can pick up. Yeah, Mr. A, Mr. B, Mr. C, they have entered into a JV. Now please remember, question is talking about a JV. Question will not specify always whether it's a JCO or a JCA or a JCE. So that assessment will have to be done by you. But yes, of course, the question will talk about a JV because all of these will be a JV to begin with. Correct? Yeah, so they will always be a JV to begin with. Okay, so Bhavna is asking, so in JCO, there are no consolidated financial statements. Yes. And that is what you'll exactly see. Huh? So let's go through this question and then I'll come back to your doubts. Okay, if at all they remain. Okay, now this JV has been created to purchase land, construct and sell flats. So there will be a land on which they will construct and sell flats. Mr. A purchased a land. So now this responsibility between A, B, and C is also defined. So what A is doing is A is purchasing a land for 60 lakhs on 1st January X1. And for this purpose, he took a loan from bank for rupees 50 lakhs at 8% per annum. He also paid registration fees rupees 60,000 on the same day for purchase of land. Okay. All right. So now Let's talk about the responsibilities of B. Mr. B supplied the materials for rupees 4,50,000 from his godown, and further he purchased the material for rupees 5 lakh for the joint venture. Okay, so the responsibility of B is also specified. So B is purchasing the material, okay, for the JV, and some part of the material B already had in his godown. Okay, so he is supplying that. In any case, for the business, B is providing total material worth of 9,50,000. Yes or no? Okay, then moving further. Mr. C met all the expenses all the other expenses which were in relation to advertisement, labor, and which are any other incidental expenses. Okay, which amounted to 9 lakh. So that's the understanding with Mr. C. Okay. On 30th June X1, each of the venturer agreed to take away one flat each to be valued at rupees 10 lakh each. Yeah. And the remaining flats were sold by them. So what has happened? All the flats were constructed. Once the flats were constructed, so three of them decided that they will take one flat each. So when they will take one flat each, so the valuation of each flat has been decided that they will keep the value of each flat as rupees 10 lakhs. Okay. In respect of the flats which they are taking. Okay. And the remaining flats. So what do? They will sell those. Now, Mr. A sold the flats for rupees 40 lakhs, B for 20 lakhs, C for 10 lakh. Okay, so this is the amount of sale consideration which they would have received from the sale of flats. On the same date, when the flats were sold, loan was also repaid by Mr. A along with interest, and any net proceed means after paying all of these liabilities, etc., were shared by the partners equally. Okay, so they have shared this equally. So that's the understanding they are having right now. Yeah. You are required to prepare draft consolidated profit and loss account. So what do you mean by this draft consolidated profit and loss account? See, clearly it's a case of JCO. Yes or no? Why? Because to begin with, we knew it's a case of JCO. That's one. Further, even if we don't know, so we understand that each venturer has got his own shares in respect of various resources, yeah, incomes, expenses, etc. And anyways, this JV doesn't appear to be a separate legal entity. Yes or no? So therefore, what all of these venturers will do is they will record their portions, their shares in their own books. How will that be done? We'll have to look at that. Yeah, and that's why question is asking you to prepare joint venture account. Joint venture account in the books of each venturer. Means each venturer in its books will record some part of this JV. So that's why it's been called as JV account in the books of A, in the books of B, in the books of C. So where will you find this accounting? JCO? Yes or no? You will find this accounting in case of a JC only. Correct? Now, now, let's try to understand the requirement to have this draft profit and loss. Because you may be thinking, sir, consolidated financial statements we don't prepare. So why there is a need to prepare this consolidated profit and loss? Yes or no? See, at times, maybe to have some control, you can say a draft accounting could be required. Why? Because that may help all the venturers in doing what? In doing the accounting entries, in recording all of these in their books. Yeah. That's why what has been required is not the consolidated financial statements of the JV, but only the consolidated P&L. And that too, a draft version. Yeah. So can you see the word draft? Yeah, means it's not final. It's not something which is a proper accounting record. It's only like a working. Yeah, but for your purposes, it will not be a working. Why? Because it's the main requirement of the question. Understood? Yeah, clear? Okay, so now what we will do is we will get on to this draft P&L. Okay, so let's look at this draft P&L first. Now, because it's a P&L of JV, it's a P&L of JV. So what will you have? In this P&L of JV, we'll have to keep all the items which are generating any sort of revenue or which are resulting into any kind of expenses. Yeah. Okay. So do we have that? The answer is yes. So as regards the purchase, we understand there's a purchase of land, 60 lakhs. Correct? So you will record this. Yeah. Okay. Then on this land, registration fees was paid. So you'll record this. Okay. So now quickly, we can just keep looking at that in the question. Land is there, 60 lakhs. Registration fees is there, 60,000. Correct. Okay. And then we also understand there's interest. So this interest will also go to P&L. Okay. Now we can see this interest in the P&L. Yeah. And can you tell me how is this 2 lakh interest computed? Over to you. Can you show me the basis for computation of this interest of 2 lakhs? Quickly, over to you. So how do you get this interest of rupees 2 lakhs? Great. So Dilip says if you compute 8% interest on 50 lakhs, what do you get? 4 lakhs. But in this case, you are required to compute this only for 2 months. That is what Abhishek says. Yes or no? Yeah. So you will compute it only for half year, 6 months, right? Why 6 months? Because this loan was taken on 1st January X1. Correct? And this was repaid on 30th June X1. Understood? Yeah. Okay. So only for 6 months this loan was there. Right? Clear? Everyone? All right. So now, so I think three things have been plotted in the P&L. Then we also understand that Mr. B brought in material. Yes. So the total material worth of 9,50,000 is the cost for JV. And we understand C incurred various expenses, advertisement. So if you go look at the question, advertisement, labor, other incidental expenses. So this will also go to P&L. So this again we take to the P&L. Okay. Now, do we have any other expenses to be recorded in the P&L? If you look at the information of the question, can you see any other expenses? No, there doesn't appear to be any more expenses. Yeah, so expenses are done. Now, let's look at the credit side, income side. So one, there's a sale of flats. A has got 40 lakhs, B has got 20 lakhs, C has got 10 lakhs. Yes or no? Yeah. So this sale should be recorded 40, 20, 10. Correct? भावना is asking, but sir 60 lakhs को क्यों डाले P&L में? Which 60 lakhs you're saying? This one? This 60 lakhs? Is this the one, Bhavna? So why don't you think it should not go to P&L? Tell me. So what's the reason? Why do you think it will not go to P&L? Tell me what's the rationale? Why it should not go to P&L? So where will it go otherwise? Can you tell me? So if you don't take it to P&L, where will it go? Is it not a cost? Is it not an expense? Okay, so Bhavna is saying, sir, it's a fixed asset. No, it's not a fixed asset. I think therein you are confused. Huh? If you go look at the business of this, sorry, this business, if you look at of this JV, what is the nature of business? To purchase land, construct flats, and sell them. So in this case, the land which you purchase, will you take it to PPE or inventory? Tell me. The land which you purchase, will you take it to PPE or inventory? Tell me quickly. What do you think? Everyone? Yeah? Clear, Bhavna? Yeah, because this is in the nature of inventory. So that's why for this business, what is this? This is nothing but like any other purchase. Correct? Yeah? Okay. Now, sale we have recorded 70 lakhs. So this goes to P&L. And then we have flats which have been taken away by A, B, and C each. And the value of each flat was 10 lakhs. So that's why it will be 30 lakhs. Okay. Yes or no? Now, do we have any other item to be taken to this P&L? No. So now, what can you do? You can close this P&L. So if you close this P&L, so what do you have? Profit or loss? It appears to be a profit. Yeah, so there's a profit. So now, this profit belongs to whom? Three persons, A, B, and C. And in the question, because the ratio is not specified, so what will you do? You will distribute in equal ratio. Okay. Yeah. So this will go in equal ratio. Great. Abhishek says 1 is to 1 is to 1. Yeah. So A will take up 630, B 630, C 630. Okay. Yeah. Okay, so Kasak says equal mentioned in the question. No, so equal mentioned in the question is about net proceeds, not necessarily the profits. So we'll have to assume that profits are also shared equally. Yeah. So even if the question is silent, you will assume that equally. Okay. All right. So now the first requirement of the question is completed. But that JCO accounting has to be done by each venturer. That is not yet done. And anyways, if you look at the JCO, this P&L that you prepare is what? This is a draft one, or this is a working. So where will you actually require this working? This will be required in recording in the books of respective venturer. So now let's move to books of Mr. A, B as well as C. Now please remember, in the question, it will be better if you can open these three accounts simultaneously. Yeah, that will help you. Why? Because you can just post all of these accounting entries simultaneously. So that will be helpful. Fine. So whenever in the exam you are required to solve this, just leave some space. Yeah, maybe the extra space you can leave, and that's how you will prepare the JV account. So now, in the books of A, there is a JV account. In the books of B, there is a JV account. Similarly, in the books of C, there is a JV account. Right? Now, in the books of A, now we will do this one by one. Okay. In the books of A, now A has taken a loan. Yes or no? For purchase of land. And the land was worth rupees 60 lakhs. Okay. So this land 50 lakhs has come from the loan amount, and remaining 10 lakhs would have been paid by A only. Yes or no? Would have been paid by A only. Yeah. So land worth of 60 lakhs is recorded. 50 was out of bank loan, which again A had taken. 10 out of own funds of A. Correct? On this land, registration fees was paid. That was again paid by A. Okay. Loan of 50 lakhs because A had taken this. So A will pay the interest. So A is paying the interest. Okay. Now, as against this, what did A get? A got 40 lakhs from sale of assets, cash, and A also received one flat. Okay. By flat equivalent to 10 lakhs. Yeah, that's the valuation which they have discussed. Okay. Now you will not close the account of A because you will not be able to do that. Even if you want, you will not be able to do that. So that's why what we will require is to move on to books of B as well as C, and then we'll close their books simultaneously, right? Now, if you look at B, so B purchased material for 4,50,000, correct? Sorry, B transferred material. I think this material 4,50,000 was transferred from his godown. Yes, so this 4,50,000 was transferred from his godown. Correct? Okay, great. I think Larry has the same point. Yeah. And 5 lakh worth of material was purchased. Okay. For which B would have made the payment. As against this, B received 20 lakhs from sale of the value of the flat. Correct. Let's look at the books of C. C paid for various expenses, 9 lakhs. Yeah. And C also received one flat of 10 lakhs and sold one flat for 10 lakhs. Okay. Now, in the P&L, the profit which is generated for three parties, that should also go to their account. Yeah. So we'll transfer this profit to their account. So to profit on JV. Yeah. To profit on JV. Similarly for C, profit on JV. Okay. Now what you will do is now you will close their accounts. And when you will close their accounts, so you will find that some of the persons may have excess cash, some of the persons may be short in terms of cash, which need to be shared by them equally. So it says in the business, at the end, whatever will be left out, net proceeds means whatever is left out. So that needs to be shared by them equally. So that's why if you look at A, if you look at A is currently short of funds. And we are not talking about short of funds on overall basis for A. No, because we are only looking at the JV business. Yeah, so A says that in respect of this JV business, whatever amount I have spent, yeah, is more than what I have received so far, 50 lakhs. Correct? So A has spent, or you can say, including the profit, A should have received 68 lakh 90,000. But actually, A has received what? 50 lakhs only. Okay. So that means this 28 lakh 90,000 shortage has to come from whom? B and C? B and C? Yes or no? Yeah. So now let's go to the books of B and C. So if we go look at the books of B, so what do we find? B received 30 lakhs. B received 30 lakhs, which was more than the amount B spent, including his profit share. So that's why this excess payment of B should go to whom? The excess cash from the JV business, which B is having right now, should go to whom? Should go to A. Yeah. To cover up this shortage. Correct? Yeah. Okay. But still, A is short. So let's look at C. Now, if you look at C, C has got 20 lakhs from this business. And if you look at the amount C has spent, including the profit share of C, C is also having some excess bank, excess cash. Yeah. So let's move this fund as well to A. Yeah. So let's move this fund as well to A. So if you do this, you will find at the end shortage of A is over. And this is how you will close their accounts. Understood? So this is how you will close their accounts. Okay. Everyone clear? Yeah. Everyone clear? So every time when you look at the JCO accounting, this is how you need to do this. Any questions, any doubts if you have, please ask me. Over to you. And in the exam, as we discussed, that whenever you have such type of questions, please open the JV account in the books of all the three parties. That will help you. One, you will be able to solve that faster because you will be posting all the entries, all the transactions. Yeah, as and when you see that in the question. Yeah, so your speed will increase, and of course, you will get the clarity as to how to make up this shortage. Hardik is asking, sir, will there be any hint in the question through which we can know that it will be a JCO? Yes. So if you look at this particular question, so this question said you are required to prepare JV account in the books of each venture. Okay. And in this case, you are not asked to prepare the JV balance sheet, JV financial statements. Yeah. So some of those things you are not required to do. Correct? Yeah. So I would say this is one of the hints, anyways. Of course, you'll have to look at the entire arrangement first of all. So these are some of the hints which you can consider. But you need to be very, very careful. Yeah. And I'll tell you why you need to be careful as we move further. Okay. Abhishek is saying, okay, so he has a query. Yeah. So Abhishek is asking, sir, how was this 14 lakh 20,000 computed? This one? Are you talking about this amount, Abhishek? Tell me. Yeah, this one. Okay, so it seems he's done. No worries. So quickly. So this 14 lakh 20,000 has come from B. So if you close the books of B, B was having surplus cash, which has been transferred to A. Then I can see this query from Kasak. She is asking, sir, if the balance is left by B and C to transfer to A, exceed the expenses. Example, instead of 14 lakh 20,000, 4 lakh 70,000 more amount was transferred. See, that will not happen. Please understand. Why? Because if you say that at the end, okay, I can understand your question. You're saying at the end, what if B was having 15 lakh of surplus cash and C was having 5 lakh of surplus cash? Yeah, so that's your question in a way. Yes or no? So now what you do effectively? Yes, yes. Now effectively, what do you have? You have a surplus cash which has not gone to either A or B or C. Yes or no? Please understand that situation will not arise. Why? Because if the JV business would have generated some profit that you would have considered anyways here. Yes or no? Now, let me just also help you understand this further. Say, for example, you prepare the account of JV in the books of three ventures and you take out this item profit on JV from accounts of all the three partners. Take out this item, prepare this account, and remove this item. So, what will you get?
Sir,
There will be a
please
surplus
repeat.
cash. Sorry, I understand somebody has a query.
Sir, please repeat. In the books of Mr. A, JV account.
So, what do I need to repeat? Sorry. Please go on. See, if
Please
you,
repeat JV account, sir, Mr. A.
so what do you mean by please repeat JV account? I couldn't understand.
Registration, bank interest.
How do you compute bank interest? Yeah. See, this bank interest is paid by A. Okay. So if you go look at the question, A took a loan from bank for 50 lakhs at the rate 8% per annum. Okay. So who paid this interest? A. So that's why it is going to the books of A. Okay. Okay. So I think Anil has understood. Maybe I lost it in between. So a couple of things I think you want to understand. One, registration and bank interest. So bank interest we just discussed. 2 lakh is the amount of interest. Who paid this? A. So that's why it will go to books of A. Second, if you look at this registration fee of 60,000, who paid this? Again A. Correct? So A has made both these payments. Registration fees 60,000, bank interest 2 lakh. So that's why it's gone to books of A. Clear? Clear? Now, moving further to the query which I think Kasak asked me and which I was just trying to explain at that point of time, that if you remove this profit share from the accounts of these three parties, so you'll find there is a surplus cash amounting to 18 lakh 90,000. Yes or no? Yes or no? So if you do this, you will find there is a surplus cash in the JV business. Yeah? Clear? Understood, Kasak? Yeah? So why was there no surplus cash left after this distribution? Because that's been taken care of through this accounting entry of profit. Okay? Through this profit, any surplus cash which was generated, that's been distributed. Okay? Very good. So Kasak is clear on this. What about others? Any more questions, doubts if you have? Abhishek is asking, sir, what if C still has a surplus after 4,70,000? See, Abhishek, that is what I just explained. That is not possible. Okay, that is not possible. Why? Because this accounting which A, B, and C are doing is in respect of what? One business. Okay, so they are not preparing their entire books, only the portion of this JV business. Three of them are recording. Okay, and how do you do accounting? It's on a double entry basis. That's how you do the accounting. Yes or no? So for every debit, there is a credit. Correct? Now, when they will take up, now when you will distribute this business between these three, A, B, and C, and if you do that properly, means you don't leave anything. So how can anything still remain which is undistributed? So if that remains, maybe you are doing some error. Otherwise, that's not possible. Okay. For which I think we also discussed this. Yeah. So if you go back, let's suppose this is the business. Huh? Well, let's suppose this is the business. Now this business needs to be distributed amongst whom? A, B, and C. Yeah. If they divide that and they record their portions equally, so what will happen? First of all, you will be done with this part. Then you will be done with this part. Then you will be done with this part. After that, if you say, sir, what if there is something left? How is that possible? Huh? How is that possible? That is only possible when you skip some of this, when you skip some of this, okay, anything if you'll skip, only then it will be possible. Otherwise, it will not be possible. Okay, clear, Abhishek? Yeah. And for ensuring that nothing gets skipped, the question requires you to prepare draft P&L as well. Neeru is asking, sir, why did B and C paid surplus to A? Because there was a business. Okay, let's try to understand this. There was a business, JV business. Yeah. And this business belongs to three persons, A, B, and C. Yeah. In this business, every proceed or every money which is generated was required to be distributed amongst whom? Three of them equally. Okay. But maybe at a certain point of time, let's suppose B took rupees 10 extra, C took rupees 5 extra. Yeah. Maybe the way they were carrying out the transactions, they were managing the business. So what has happened? At the end, when you close, so let's suppose at the year end, let's suppose these were three friends and they were sitting together. Okay. So what did they decide? Or let me just put it in this manner, Sanya, that sorry, I think this question came up from Nero. Okay, let's suppose Nero, the understanding was such. Let's suppose there are three friends. Okay, so they are saying, let's get into a program, and in the program, any expense that will come, will share that equally. Yeah, but the way a lot of transactions took place, okay, maybe more amount was spent by A and lesser amount was spent by B and C. Okay, and at the end when this program got ended, so A said that I am short of 15, means 15 is what I've spent extra. Yeah, why? Because let's suppose initially they had 100 each, and they said that on this program rupees 300 is required to be spent, so we'll spend rupees 300 equally, but A ended up spending 150. Okay, and when B and C checked, they found that B has spent only 85. So that's why B was having rupees 10 extra. And C found C spent only 95. So C was having 5 extra. Now in this case, should B and C give 10 and 5 respectively to A or not? Tell me. In this case, Neeru, you tell me, should they do this or not? Neeru, quickly, over to you. Yes, Neeru, over to you. Should they do this or not? Yeah. And why should they do this? Because that's the understanding they had. That's the understanding they were having. Yeah. That any net proceeds which they are having has to be shared equally. Yeah. So same goes in this example. So in this example, there was a JV business. In this JV business, some money was generated. Okay. And this money was generated by three partners. Okay. Why? Because they were running the business. But one of the partner A spent more amount, and the other two partners B and C, they spent lesser amount. So at the end, at the year end, when they will sit together, and in respect of only this JV business, when A says that I'm short and B says yes, we have a surplus, C, we have a surplus, so where should it go? A only. Yes or no? So that's how you will distribute. Yes or no? That's how you will distribute. Tambeshwari says in real life also will do like this. So business is no other. Business is all about the understanding that you are having. Yeah. So the understanding which three partners were having. So this was the understanding between three partners, and that's how they have done this. Understood, Neeru? Clear on this? Neeru, you're clear on this now? Great. Okay. So I understand Sania has a query. Okay. Sania is asking, sir, venturers will incur losses only when JV incurs loss? Yes, of course. See, because in this case, venturers are only recording the JV business. Okay, so that's why if the JV business will have a loss, that's what the venturers will record. Otherwise, they will not have anything else. Okay, otherwise, they will not have anything else other than this. Clear? Yeah? All right. Any more questions if you have? Ambeshwari asking, whenever surplus is not in B and C and A also have shortage, then what to do? There again, I think you are not trying to understand the concept. I think you're just trying to mug up some of the points. Remember, Tambeshwari, I told you that if you remove the profit entry from the JV account of each partner, there will be a surplus. Remember that? Yeah. And if you say that, what if, sir, all three of them have a shortage? So that will be possible when in your P&L there is a loss. Then three of them will have a shortage. Okay. And if that is the case, let's suppose JV has generated a loss. So obviously three of them will have a shortage. Then what will they do? They will have to bring in cash to take care of that shortage. Yes or no? Yeah. So I think you need to be clear about the JV business. Huh? So it's all linked to the JV business. If the JV business has a profit, that will always lead to a surplus. But the situation which you are asking right now of a shortage will not arise in this example. That can always arise, but that can arise only if the P&L of JV is resulting into a loss. Okay, clear, Tambeshwari? Yeah, yeah, everyone clear? All right, great. Let's move further. So now what we will do is we will try to understand about jointly controlled assets. Okay, and we'll also try to look at one example around it. Now, when you will go through jointly controlled assets, okay, so there could be some confusion. Now, the confusion could be in relation to its difference from JCO, because some of the things you may find to be common. They are not very common, but some of the things, huh? So we'll talk about that as well. Yeah. So now, what do you have in case of JCA? I think we can first of all look at one example. Huh? See, in case of JCA, the understanding between the partners is what? Say there are three companies A, B, and C. Okay. Now, if they want to share some assets, so we are very specific to assets now. Or if let's suppose they jointly control assets, or they jointly want to control an asset which they can use for their own business or maybe for the business of the JV. Yeah. So in this case, the dominant part is what? Asset, which is resulting into a partnership, or you can say which is resulting into a JV. For example, let's suppose there's a pipeline. Okay, let's suppose there's a pipeline. Say this is the pipeline. Okay, so this is the point from which this pipeline goes, and this provides crude, petroleum, etc. to the customers. Let's suppose this is the second end. Okay, now this pipeline is common. Yeah, this pipeline is common for supply of petroleum. Now, if this is common through which supply can be made and the source from which this supply of petroleum is made, let's suppose at this place, there are three parties, A, B, as well as C. Okay. So all of three are involved in terms of taking up the supply of petroleum or say crude oil. And after that, what do they want to do? They want to transfer this. Okay. They want to move this to the customers. But the pipeline is common. So in this case, what these three parties can do is they can just say, for the purposes of their operations, they can jointly control this. Or you can say this pipeline could be set up by three parties jointly. Yeah. Now, in this case, A is running its own business. What is that? To supply crude oil. B is running its own business to supply crude oil. So they are into, let's suppose, similar business. But let's suppose this asset, this pipeline is what? This is an asset. Okay. Let's suppose it's not practically possible to set up various pipelines. Yeah, because this is a significant infrastructure. Or even if this is practically possible, let's suppose this involves significant cost. Yeah. So what A, B, and C are trying to do here is they are trying to pool this asset. Okay. So they are trying to pool this asset. So how are they trying to pool this asset? So they may decide that during the day, let's suppose for 4 hours, A will supply, 4 hours, B will supply, for 4 hours, C will supply the crude oil or the petroleum using this pipeline. Yeah, so they have dedicated their 4 hours. Let's suppose this is 8 to 12. Okay, let's suppose this is 12 to 4. And let's suppose this is 4 to 8. Now, this could be any time slot. Okay, now in this case, here again, do we have a JV? The answer is yes. That's the beginning point. In case of this JV, A, B, and C are having their own businesses. They are having their own businesses. Correct. And what they are trying to bring in is they are trying to bring in one asset which will be commonly featured and used for the business purposes. Understood? So this is what you have in case of jointly controlled asset as against jointly controlled operation. Understood? Everyone? Yeah? Everyone understood about jointly controlled asset? Yeah? Anil is asking very few common features. That's good. So if you find that to be different, that's good because eventually it's different. Okay, so let's look at one example. All right, so now in this example, what do we have? ABC Limited, BP Limited, and HP Limited. They have the same point of oil refinery and same place of customers agreed to spread a pipeline from their unit to customers' place jointly. I think this is the similar example that we have discussed. They agreed to share the expenditure on the construction of pipeline and its maintenance in the ratio of 3 is to 3 is to 4. So instead of equal, they have decided the ratios. And the time allotted to use the pipeline was in the ratio of 4 is to 3 is to 3. Yeah, so these ratios could be anything. You should not think that it has to be equal always. No, that will again depend on the contract. For this joint venture, each venturer will record his own share of joint assets, and any expenditure incurred or revenue generated will be recorded with other items similar to JCO. So here again, you do not have a separate legal entity. Why? Because it's all about one asset. So who will record that asset? Each venturer in their own books. Each venturer will record his own transactions in its own books. Correct? Yeah. Yeah. So let's also try to look at some of the differences between JCO and JCA to understand this in a better manner. In JCO, in JCO, venturers use their own assets for the JV business. But in JCA, they jointly own the assets to be used in the JV. Okay. JCO is an agreement to carry out operations to earn income, whereas JCA is an agreement to jointly construct and maintain an asset. So, can you understand? The underlying principle is quite different. Yeah. Third, under JCO, all the expenses, revenues are shared at agreed ratio. In JCA, only the expenses on joint assets are shared in agreed ratio. Yeah, so in case of JCA, it's all about one asset or the assets which are having joint control, over which the venturers are having joint control. Understood? Everyone clear on this? We also have one question now as around JCA, which I think we can take up after the break, huh? And hopefully with which we should get some more clarity around the JCA. Okay. Yeah. So after the break, we'll move on to this next question also. But if you have any conceptual queries as around the JCA, please ask me. Hardik is saying, sir, can we say that in JCO, no CFS will be prepared? It's not about can we say, they will not be prepared. Okay. That is what we discussed in case of JCO. And in JCA, CFS will be prepared? No. So there again, CFS will not be prepared. Okay. So in both the cases, it's the same thing, right? Okay. In both the cases, it's the same thing. It's no different, right? Okay, Nitin asking, sir, what's the difference first point? Yeah, so this point. So in JCO, what do you have? Say three parties will come together. Why? Because they want to enter into a business. Yeah, so there is a common business they want to establish. Correct? But in JCA, three parties will come together not to enter into a business or a common business, but they want to jointly own some assets. Yeah, so the objective of two types of JVs are different. Understood? Yeah, great. Nitin is clear on this. Okay, Tambeshwari is saying, so JCO using involved asset liability expenses income. Okay, yes. And in JCA, only the asset is involved? Yes. And in relation to that asset, some of the expenses could be involved. Okay, in relation to that asset, some of the incomes could be involved. You'll have to see. Okay, and I think you'll get more clarity around that once we'll pick up this question. Okay, yeah. Any more questions, doubts if you have? No? Any more questions quickly? Yeah. Any more questions, doubts if you have? Yeah. So see, if you ask about this JV, okay, so in this JV, this accounting is something which becomes complicated just because you are not able to differentiate between these three. But if you are able to differentiate between these three, then I'm sure you will understand about it. Yeah, you'll be able to do this accounting very, very easily. Dilip is saying whole record depreciation. So that is what we'll see with the help of this example. That will pick up after the break, right? Okay, so then I think we can take a break now. Yeah, all right, great. Manish, we can take a break now. Sure. Okay, so now let's move on to this question 2. A, B, and C Limited decided to jointly construct a pipeline to transport the gas from one place to another that was manufactured by them. Okay. For the purpose, following expenditure was incurred by them. Building 12 lakhs to be depreciated at 5% per annum. Pipeline 60 lakhs to be depreciated at 15% per annum. Computer electronics 3 lakhs to be depreciated at 40% per annum. And there are some vehicles 9 lakhs to be depreciated at 20% per annum. They also decided to equally bear the total expenditure incurred on maintenance of pipeline that comes to 6 lakhs each year. Now, you are required to show consolidated balance sheet and extract of P&L and balance sheet of each venture. Now, here again, so if you look at the requirement of the question, so it is asking you one about the consolidated balance sheet. So when you say the consolidated balance sheet, so that is in respect of JV. Yeah. And the extract of P&L and balance sheet of each venture means A Limited, B Limited, C Limited. Why it is an extract? Because you are given the information only about this joint venture and nothing beyond that about A, B, and C because they are carrying on their business. Yeah, so till the time you don't have the full information, how can you prepare their complete P&L, complete balance sheet? Yes or no? Okay, now in this case, if you understand the arrangement between three parties, A Limited, B Limited, C Limited, what are they trying to do? Can you tell me quickly? So, what are they trying to do? What is the objective which they want to achieve? Any thoughts quickly from your side? So, if you look at their arrangement, what is it that they are trying to do? Over to you. Yes, quickly. Very good. Hardik says they are trying to jointly control the assets. Yes or no? Yeah. So this is going to be the dominant part in case of JCA. Yeah, I think same is the response from Kasak Dilip. So every time you need to identify a JCO or a JCE or a JCA, please remember that this is how you will do this evaluation. Okay, so this is how you will do this evaluation. Correct? Yeah. So your basis of evaluation should be clear to you. Yeah. Now, moving further, we will first of all prepare the venturer account. Okay, in this case, because once you have the venturer account in respect of all of these assets, then you can place all of these items in the JV. Yes or no? So now, if you look at A Limited, so we can just start with A Limited, but as we discuss, every time you have these questions, it's better you do this simultaneously for all three. Yeah. So that will help you in terms of solving this faster. Yeah. Okay, now if you look at the balance sheet of JV, what will you have in the balance sheet? You will have all these assets. One is building, correct? 12 lakhs. And the portion of A in this 12 lakhs is what? This is equal 4 lakhs. Plant and machinery, that is nothing but the pipeline. So that is 60 lakhs. So the portion of A, you will record 20 lakhs. Computers, those were 3 lakhs. Portion of A, 1 lakh. Vehicles, 9 lakhs. Correct? Portion of A, 3 lakhs. Okay. Now, each venturer will record his proportionate share. Correct? Now, all of these assets will have to be depreciated. So the depreciation rate is given to you. On building, you will charge 5%. Yeah. And currently for 4 lakh, if you charge 5%, what do you get? 20,000. On plant and machinery, rate is again given 15%. On computers, rate is again given 40%. On vehicles, rate is given 20%. Okay. In a way, you can say that because the proportionate share of assets is recorded by each venturer, so therefore the corresponding depreciation on a proportionate basis is recorded by whom? Each venturer. I think this was also one of your questions. Correct. Now, these depreciations you will take to the P&L extract also. Yeah. So if you draw the balance sheet, what do you have? All of these assets. Yeah. So all of these assets. So if you do the total of all of these assets, what do you get? Can you tell me quickly? If you take the total of shares of these assets, what do you get? 23 lakh 80,000. That's what Nitin is getting. I think Hardik, Tambeshwari, they are having the same answers. Very good. So 23 lakh 80,000 is what you will place to the balance sheet. Okay. Now, similarly, if you take the total of depreciation on all of these proportionate shares, what is that? 4 lakh 20,000. So this you will place in the consolidated, sorry, in the P&L extract of A Limited, 4 lakh 20,000. Along with that, if you look at the P&L, so the question says, so if you go look at the question, it says each venturer needs to share the expenditure on maintenance of pipeline. So what is the total maintenance on pipeline? 6 lakhs. So therefore share of each venturer will be what? 2 lakhs. So this will again go to the P&L. Correct? Okay. Sabha is saying, sir, please tell depreciation, amortization expense. Yes. So depreciation and amortization expenses, this depreciation, Sabha. So this depreciation you have computed. Yes or no? On building, pipeline, computer, vehicles. Could you compute this? Sabha, tell me, could you compute this? Rates of depreciation are given to you in the question. So could you compute this? Yeah. So if you take the total of these, so entire depreciation expense, where do you take it? P&L. So what is the total of depreciation expense on all of these assets? 4 lakh 20,000. So this you will take to the P&L. Okay. Clear, Sabha? Yeah. All right. Now similarly, what will you do? Similarly, you will also prepare the extract of P&L of B. Now, will the numbers of B be any different from A? What do you think? Will the numbers of assets, of expenses of B be any different from A? The answer is no. Why? Because all of its assets, all of its shares are exactly same. Yeah. Still, now you may be thinking, sir, in the exam, do we have to prepare for all three? Yes. So even if the numbers, all of these things are same, you will have to prepare that for B separately. Yeah. So don't take a shortcut that it's same for B, it's same for C. No, you will have to prepare for A, B, and C. Why? Because they are three different entities. You will have to prepare their separate books. Okay, correct. Great. Kasak, Tambeshwari, they have also given the reasons. Very good. Now, similarly, if you look at C, for C, it's the same amount. It's the same amount. Yeah. You have this similar extract of P&L and you have the same extract of balance sheet. Correct? PP. Yeah. Okay. Now, with this, what we have done is, excuse me, we have prepared the extracts. Excuse me, which was the requirement of the question. Extract. Okay. But in the question, you are also required to prepare consolidated balance sheet. Okay. Now, in the consolidated balance sheet, what will you take? All of these assets. Yeah. So if you take all of these assets in the consolidated balance sheet, so 23 lakh 80,000 was the total of asset share of one venture. So 23 lakh 80,000 is for one. And how many ventures do we have? Three. So what do you get? 71 lakh 40,000 as PP, and corresponding to that, you will have to have a share capital. You will have to have a share capital in the balance sheet. And how do you present it? So PPE share of each venturer in the form of land and building, in the form of plant and machinery, in the form of computers, in the form of vehicle, which you have shown in their extracts. You will have to pick up, you will have to pick up, and you will take it to the consolidated balance sheet. And corresponding to each venturer, you'll have to bring in their capital. So that has to be equal. Only then they will be able to set up these assets. Yes or no? Yeah. So can you see this consolidated balance sheet is completed with this? That's it. In the consolidated balance sheet, will there be anything different? No, because this is only to demonstrate how it will look like. Yes or no? For JV business, the idea is what? To go and check that conceptually, what is the proportion of assets? Yes or no? Now, for checking that, what do you do? This again, you prepare a sort of draft, because this balance sheet will have one asset which will keep getting depreciated. And how are those assets coming into existence? Through the contribution by the venturers. Yeah. In this balance sheet, do we need to include any such item in the nature of expenses, reserve, and surplus? No, that is not required to be shown. Yeah, because it's a JCA wherein the assets are jointly owned. Clear? Everyone clear on this? Simple, easy to understand. Any questions if you have around this? Hardik is saying, sir, if there would be other line items in the balance sheet like trade receivable, payable, and all, no, then I would say it's not a case of JCA. Then it would be a case of JCE or JCO. Okay. Neeru, Tanu, they are clear. Hardik is clear now. What about others? Quickly, any questions, any doubts that you may have? Okay, Bhavna is asking, sir, how to know the related Okay, so Bhavna, this is what I've been trying to explain you. Huh? Have you understood the concept of JCU? Bhavna, tell me, have you understood the concept of JCU? Tell me quickly. Bhavna, are you clear on the understanding of JCU? Quickly, huh, Bhavna? Yes. And are you clear on the concept of JCA? Are you clear on the concept of JCA? Very. See, if you understand these two, so around this, we also looked at their differences. Remember, these were the differences we looked at. Yeah, these three. So every time there is a question, what do you need to find out? On the basis of their conceptual understanding. Yeah, then it's very hard to understand your AC or JCO. Yes or no? Yeah. Sabah Shakil is asking, sir, same entry for A, B, and C. Yes, of course. You tell me, should it be different? Tell me. Dilip is asking, sir, in case of JCA, there will be no share capital. No, I think this example that we just covered, yes or no? This was a case of JCO only, and there was a share capital, correct? But if you are talking about this extract, okay, in this extract, now this extract is for what? A limited, B limited, C limited. Now in their companies, means in their own financial statements, what is the amount of capital? We don't know about it. Yeah, because this is not the only asset in their balance sheets. In their balance sheets, this is not the only asset. This is one of the assets. And that's why question is asking you to prepare extract of balance sheet. Okay, that's why you are not showing any share capital here. Clear? Dilip, clear on this now? Tambeshwari, I think you are just trying to mug up this. Okay, the way you are asking some of these questions, please ignore this. Huh? Don't create any such formula. For JCA to say every time there will be a P&L and balance sheet, the answer is no. For JCO to say every time there will be only P&L, the answer is again no. Why? Because we discussed that conceptually you don't prepare CFS in those cases. So why are these prepared now? Only for control purposes, only to get onto the concept. Okay, so that's the basic understanding, which if you want to mug up, you can do that. Okay, so cramming should be done to that part, not to this part. Okay, why? Because this is one of the question which required this, and that's why we've done this. So it doesn't mean that every time there will be a question, so this will be required, or otherwise any other thing will not be required. Okay, don't take that approach. Huh? That is very, very risky. Okay, clear? And that's why I'm again asking you that in terms of JCO or JCA, are you conceptually clear? Number one. And if you are conceptually clear, then you should go to these differences. Because the moment you are conceptually clear, you will be able to differentiate between these two very easily. Because generally there is a confusion between JCO and JCA. Okay. Yeah. So that's why it becomes more important. Fine. Clear? Tambeshwari, clear on this? Great. All right. So now what we will do is we will move on to the third type of joint venture, which is called as JCE, jointly controlled entities. Let's look at one example to discuss this. With the help of this example, we'll just try to get some more clarity around JCE. Okay. Now, A and B Limited A and B Limited are two infrastructure companies operating in city A. The local authority has issued a tender to construct a metro stretch for rupees 2000 crore and had invited bidders to apply for the tender. A and B Limited jointly form a new entity, AB Limited, that bids for the tender. All machinery equipment will be the responsibility of A. All funding will be managed by B. Revenue and expenses will be shared by A and B. Now, this is an example of A and B coming together, forming a JV, and that JV becoming a jointly controlled entity. Okay. Now, let's try to understand this. So far, every time when a JV was created, every time when a JV was created, what did we have? Let's suppose A Limited was there, B Limited was there. Okay, so they were pooling their resources, all of those things. Okay, which is going to happen even now. Now, what is the objective? There are two companies running their own businesses and they see there's an opportunity. But individually, it's difficult for them to get into that opportunity. So that's why what do? They come together. But now they create a separate legal entity. They create a company. Let's suppose this company is C Limited. And this new opportunity, this new business opportunity, what will they do? They will run the business in this company. So does it mean that A Limited will come to an end? The answer is no. Does it mean B Limited will come to an end? The answer is no. Means A Limited, B Limited will continue to remain there. So they will have their businesses. They will have their businesses. Over and above that, over and above that, a new company will also come up, which will also be running a different business or maybe a similar business. We don't know. Now, for this company, again, what will happen? Capital will be required, assets will be required. So, who will bring that? Both these parties. So, they will contribute to this. Yeah, effectively, they contribute the capital. And in this company, any profits or losses which are generated, they belong to whom? Their shareholders, in a way, A and B. Yeah, so they will have their profit sharing ratio. Yeah. Now, the point is that any pooling of resources which has been done that belongs to the C Limited now. That belongs to C Limited. Why? Because C Limited is the owner of this. Okay. Now, in this case, A Limited will prepare own financial statements plus consolidated financial statements, wherein if let's suppose share of 40% of C Limited, so A will consolidate 40% of C Limited. B Limited again will prepare own financial statements plus consolidated financial statements. If B has a share of 60%, so B will prepare consolidated financial statements in which B will consolidate B plus 60% of C. So in this case, again, there will be a line by line addition, similar to what you see in case of subsidiary, but the line by line addition in this case will be on a proportionate basis. It will not be 100% line by line addition. It will be proportionate line by line addition. Okay. So the method of consolidation that you have in this case is through what? CFS to begin with. And in the CFS, what do? Proportionate line by line consolidation, which is also called as proportionate consolidation method. Clear? Clear? Everyone clear on this? Yeah. So this is the methodology that you follow. Yeah. Ajay is saying like Tata Starbucks. Yes, you can say that. Wherein Tata Starbucks are operating through a JV, yeah, and that JV is running the business. And for that business, the proportionate share is taken up by Tata and the other end. Yes, clear? Everyone clear? So I think we can look at one example now to get some more clarity around this. Okay, so let's look at this example. A Limited, a UK based company, entered into a JV with B Limited in India, wherein B Limited will import the goods manufactured by A Limited on account of JV and sell them in India. A and B agree to share expenses and revenues in the ratio of 5:4 respectively. Yeah. So revenue, expenses, a certain ratio is given. Profits are distributed equally. Now you may be thinking, sir, how is it possible? Yes, that's possible. Huh? So asset, liability, revenue, expenses, profit, or any other thing, for all of them, the ratios could be completely different. So you should not think it has to be same always. Yeah. A Limited invested 49% of total capital but has equal share in all the assets and is equally liable for all the liabilities of JV. Following is the trial balance of JV at the end of first year. Okay, so this is the trial of JV. Please understand. Purchases, other expenses, sales, PPE, current assets, unsecured loan, current liabilities, capital, closing inventory, means stock. You are required to prepare consolidated financial statements. Now, in this case, you are not required to record all of these items in the books of venture. No. Only consolidated financial statements are prepared. Means over here, the meaning of this consolidated financial statement is what? You are preparing the financial statements of the JV actually. Okay. So that is what they are trying to say here. Okay. Now it's very simple. So it's like you are given a company for which trial is given. And what do you need to do? You need to prepare the financial statements. As simple as that. Yeah. So now let's plot all of these items in the P&L. So revenue 13 lakh 5,000. Then you have purchases. Then you have other expenses. So purchases, other expenses. Yeah. Then there's of course change in stock. Change in stock is there. Yeah. So closing stock is 1 lakh. Opening is nil. So what do you get? PBT. Simple, huh? Now in this case, it's so simple. Why? Because it appears to be a consolidated financial statement, but actually, what do you mean by console? In console, they are just trying to say balance sheet P&L of this JV company. Simple. Okay. So P&L we have prepared, right? P&L is done. Now let's move on to the balance sheet. On the balance sheet, once again, what do? You'll pick up the information from the trial only. So share capital is there, 4 lakh 1,000. Then we are given unsecured loan, current liabilities, PPE, current assets. Yeah. So we just need to simply place these numbers. We just need to simply place these numbers. Okay. And what we can do is we can just plot all of these items. Other current assets. The only point is when you will plot these amounts in the notes to accounts. So the proportionate share of two parties you will show. So assets are shared by them equally. So other current assets, A and B, 1 lakh. Inventory, A and B, 50,000 each. Okay. PPE, 3 lakhs each. Why it's 6 lakhs? Current liabilities, those are again equal, 50,000 each. Unsecured loan, again 1 lakh each. Why? Because the total is given to you in the question and you are just dividing it to two parts. Profits. Where do you get these reserves from? Profits. So these profits will go to the reserves, 1,99,000, and the profits are distributed in equal ratio. So 1,99,000 you will divide equally. For share capital, your ratio is given. What is that? 49 is to 51. 49 is to 51. So that's the ratio which is given. Yeah. Then I think closing stock we have already considered. Yeah. Other expenses we have considered. Purchases we have considered. Yeah. So all of these items we have already considered. Okay. Now, if you plot all of these numbers, so what do you have? Share capital, reserve and surplus coming from P&L, long-term borrowings again given in the trial itself, current liabilities given in the trial itself, PP given in the trial balance, for which no depreciation is required, inventory, other current assets. So you can see it's a very, very simple question. The only thing which is getting tested in the question is your knowledge, and that too about the sharing of amounts in respect of all of these items amongst two parties. That's it. Can you see this? Yeah. So that's the only thing which is tried to be tested over here. Yes or no? Yeah. Everyone clear? Any questions? Any doubts if you have? Over to you. Any questions? Any doubts if you have? Quickly, huh? Okay. So Kasak is asking, sir, JCE is a separate entity. So separate accounts for its are also prepared? Yes. Unlike what you do in case of JCO and JCA. Okay. Second question from Kasak. She is asking, sir, whether the question specifies or not, we have to prepare CFS? No. Only if the question will ask you, you will do that. Why do you want to do unnecessary work? Isn't it? Yeah. Because the examiner will also not give you unnecessary marks. Yeah. So you also do something which is required. Huh? If the examiner is not doing anything additional, why do you want to do anything additional? Okay. And again, that when you are talking about CFS, so that's a big thing. Okay, that you will not prepare until unless it's specified. Had it been a working or any note or any sort of accounting entry, yeah, that you can always consider. But when you are talking about CFS, okay, so it's a big thing, which will be a time-consuming task. Do that only fast. Okay. Hardik is saying, sir, in change of stock, we do closing stock less opening stock. Correct? Yeah. Yes. Closing stock less opening stock. So that's what you'll do. And I think same thing we have done here. Huh? Yeah, change in stock. Yeah, but because the closing stock was more, opening stock was nil. So that's why your profit will increase. So that's why it should be negative. Huh? That's why it should not be positive. I think you're just trying to ask me whether it should be positive or negative. It will be negative. Yeah, because the change in stock will result in increasing the profits. And if you take it to expense side, what do? You will have to show it negative. Correct? Anil is asking, sir, only in JCE separate legal entity is formed? Yes. And that's how it's different from other two. Okay. And that's how each of them are different. Yes or no? That's how each of them are different. Hardik is saying, to sum up, can we say that JCO, there's no separate legal entity and pooling of resources is done? Yes. And will transfer to business account? Yes. In JCA, there is a common control on asset? Yes. And in JCE, there is a separate legal entity? Yes. Yeah, so absolutely correct. What you are saying is absolutely correct. Okay. All right. So then I think we have little time left, but still, I think we can just move on to one more question. Okay. So let's look at this question. A Limited entered into a JV with B on 1:1 basis, and a new company C Limited was formed for the same purpose. And following is the balance sheet of three companies A, B, C. So that's given to you in the question. Okay. Balance sheet is given. Financial statements are not given. Only the balance sheet. You are required to prepare the balance sheet of A Limited and B Limited using proportionate consolidation method. Simple. So simple, huh? So in this case, what is it that you are required to do? Consolidation. Means for A, its standalone financial statements are given. Now what do you need? Its consolidated financial statements. For B, its standalone financial statements are given. For B, you will prepare consolidated financial statements. So tell me, will you also prepare consolidated financial statements for C in this question? Let me just check. In this question, will you also prepare consolidated financial statements for C? Very good. Dilip says no. Yes. Anil says yes. No. So please remember, huh? For C, how can you prepare CFS? Because C is a JV. A portion of that will be picked up by A and the remaining portion will be picked up by B. Yes or no? So A and B will pick up their proportionate share of C. But for C, you don't prepare consolidated financial statements. For C, you only prepare financial statements which are already there. Understood? Yeah? So don't get confused. For C, you will not prepare CFS. Okay? And C will not apply proportionate consolidation method because who is required to do the consolidation? Venturers. JV is not required to do the consolidation. Understood? Clear? Only the venturers will do the consolidation. JV will never do the consolidation. Clear? Clear? Okay, now let's look at the balance sheet of A Limited first. Now, in the balance sheet of A Limited, what do you need to do? Very simple. Huh? All the assets, liabilities of A you will pick up plus proportionate share of C on each item you will pick up. And you will add this line by line. That's it. Means share capital 10 lakh plus 2 lakh 50,000. Reserve and surplus 18 lakhs plus 6 lakhs out of 2 lakh 12 lakh. Loans 3 lakh plus 1 lakh out of 2 lakh. So that's how you will do. As simple as that. Okay. So this is what you will do in case of C Limited. Yeah. Why? Because the proportion is given to you equal. Okay. Clear? Yeah. Now let's look at the balance sheet of A. So A is picking up its reserves plus proportionate reserves of C. Its capital plus proportionate capital of C. Its liabilities plus proportionate liabilities of C. Its PP plus proportionate asset of P. C. Now, let's also look at the capital of A. Now, A has got one investment in C, investment in JV. Now, this investment in JV, what will you do? You will knock off against the proportionate capital of C. Remember consolidation approach. Do you record the capital of the investee? Do you record the capital of the investee? The answer is no. Why? Because that will get knocked off against the investment. So that's why when we look at the balance sheet of A, okay, so now this is the balance sheet of A. In this balance sheet, only the capital of A is appearing. Can you see this? Only the capital of A is appearing. Correct? Further, in the balance sheet of A, you will not find any investment. So if you look at the standalone balance sheet of A, there is an investment amounting to 2.5 lakhs. But in the consolidated balance sheet, it's missing. Why? It's been knocked off. It's been knocked off. Correct? No, Hardik, you don't have that here. Yeah? Bhavna says knocked off means you go back to AS 21. It appears you have forgotten that. In AS 21, if the holding has an investment in subsidiary, so how do you consolidate that, Bhavna? Tell me. Investment and capital of subsidiary, do you knock off? Yes or no? Tell me quickly. Do you knock off or not? Tell me quickly, Bhavna. Do you knock it off? So same thing is the knock off here. Understood? Yeah? See, line by line addition is taking place. The only difference here is you are not picking up 100%. You are picking up only the proportionate. And that's why you also don't have any minority. No kasak. Huh? So I can see a lot of questions around goodwill or capital reserve. So you don't have that here. Huh? You don't have that here. Okay. Please don't get into that. Yeah. You will not have that. Sabha is asking, sir, how did we get this reserve and surplus amount? See, there's no competition involved. I think you are not looking at the question at all. In the question, reserves of A are given. Yes. C are given 12 lakh. Now, if you go to the balance sheet, reserves of A you will put as it is. For C, you will pick up proportionate. And what is going to be the proportion? 50%. 50%. Yeah. So this is so simple. Huh? This is so simple. Okay. Hardik, let's concentrate on the question we are doing right now. Okay. As the time permits. Okay. Of course, I'll get on to some of these queries also. Huh? Don't worry. Clear? Sabha, clear on this? Yeah. Clear? Everyone? So the same way what you will do is you will also prepare the consolidated balance sheet of B. So let's get on to that. So now in the consolidated balance sheet of B, once again, what will you have? Only the capital of B, 750. So will the capital of C will be merged? So will that be merged? No. Why? Because that will again be knocked off against the investment of B. Against the investment of B. Okay. Yeah. So the same approach you will follow for preparing the consolidated balance sheet of B. So here again, in the consolidated balance sheet of B, what do you find? On the asset sides, investment is missing. Investment is missing. And if you go to notes, there again, you will do this line by line addition. Now, please remember in the exam, this line by line addition will have marks. Okay. So you'll have to show this. So if you think that you will only present the main balance sheet, you will just skip these notes. So you'll lose out marks. Okay. Because this is the only thing which is getting tested. Otherwise, this balance sheet is like very, very simple. Yes or no? This is very, very simple. Correct? Yeah. Everyone clear on this? Yeah. All right. So now quickly, let's look at this example. Now, in this example, you need to understand that if there are any transactions between the venturer and the JV, so what do? You knock it off. That has to be knocked off because you are doing the consolidation. Yeah. Okay, so let's quickly look at this small example. A and B establish a separate vehicle entity J, wherein each operator has 50% ownership interest and each takes 50% of the output. On the formation of JV, A contributed property with fair value of rupees 110 crore and agreed to contribute his experience over the years towards this venture. B contributed equipment with a fair value of 120 crore. The carrying values of contributed assets were 180. Means the assets which they are contributing, they have a carrying value, book value of 100. But when they are brought to the JV, they are brought at fair value. Okay. So now, if you look at A has a proportionate share in the fair value of assets. Yes or no? Now, what are the fair value of assets? 120 crore, which has been brought up by B. So, whatever B will bring, A will get a share towards that. A will get a share towards that. So, that will be 60. Why? Because 50% of 120. As against this 60, what is it that A has to bring in and which will be shared by B? A will bring in this property, correct? But this property which A is bringing in, for A, what is the carrying value of this? What is the carrying value of this? 100. Yeah. So A is giving an asset worth of 100, correct? Or you can say proportionately A is giving 50, as against which A is getting a proportionate amount of 60. So that's why for A there is a gain of 10 in the CFS. Understood? Yeah, understood. Clear, everyone? Any questions, any doubts? If you have, please let me know, because with this we are done on the JVs as well, and with this we are through with the consolidated financial statements, or you can say the consolidation, whether it is what subsidiaries, JVs, or associates. Yeah, so if you have any questions, any doubts, now I can just come over to your questions. Okay, so of course, Hardik, I understand you had a question you shared with me. Yeah, so wherein the preference share capital was required to be recorded. So do you want to discuss that, or this one you want to discuss? भावना इज आस्किंग सर 100 करोड़ का 50% क्यों लिया है, 110 करोड़ का 50% क्यों नहीं लिया? बिकॉज फॉर ए द एसेट विच इज being shared, A is sharing one of its assets. So this asset is already appearing in the books of A. At what value? 100 crore. Yeah. So A is giving what? 50% of asset which A is having. Understood? Because from the books of A, in a way, what is going out? 50% of 100 crore, 50 crore. But in the books of A, what is it which is getting added? 50% of 120 and not 80, because 80 is in the books of B, not in the books of A. Clear? That's why it's been done like this. Then I think Kasak is asking, sir, what is this 80 crore for? 80 crore, see, 80 crore and 100 crore are the book values of properties and equipments contributed by A and B respectively. Means A is bringing in property with a fair value of 100 crore, book value of 100 crore. B is bringing in equipment with a fair value of 120 and a book value of 80. Clear? Sai is saying, sir, can we sum up quickly about the consolidation? Sure, let me just try to do that. Okay, so what I'll do is I'll just try to quickly go through some of the consolidation related points. Okay, so now we can just simply say that when it comes to a sorry, when it comes to a subsidiary, so what do you do? Line by line addition. Okay, in which case this line by line addition is 100%, and that's why you also get minority interest and you get goodwill or capital. So correct. As against this, when you get on to an associate, so what do you have? Equity method of accounting. Okay, you don't do line by line addition. Do you have minority interest? No. Okay, so let me just strike through this. And do you have goodwill or capital reserve? Yes. Okay. Now, if let's suppose we move to JV. Now, in case of JV, what did we discuss? There are three: JCO, JCA, and JCE. Okay. Now, for JCO and JCA, do you have CFS? In the books of venturer, in the books of venturer. Yeah, so to this we can say no. Yeah, but do we have a CFS in the books of venturer? The answer is yes. Okay, for which what he will do is line by line addition on proportionate basis, which is also called as proportionate consolidation method. Okay. Sign. Hopefully, you as well as other students are now clear in terms of what you wanted me to sum up. Okay. Yeah. Clear. Very good. So, okay. So Hardik is saying yes, sir. Both queries. Huh? Sure. So what I'll do is maybe you can just repeat your first query. You're saying 10.154 point G. Okay, let me just go to this document first. 10.154. I think that is about JV only, because I don't have any other document handy right now. So what is the page number? Okay, so this is the one. 1.4 point G. So what is point G? I can't see any point G, Hardik, here. Maybe you are looking at some old document. So I don't have any point G. Everyone clear? So I think with this we are through. Of course, I'm looking at some of the questions, doubts, but if you do not have any questions, doubts, you can just feel free to move. Yeah, and thanks everyone for your time and for your wonderful participation. Yeah, but if you want to just stay around to discuss these questions, doubts, of course, we can just keep doing that. Okay. Vidushi, I've not been able to go through this query. Maybe I'll have to just go through this and come back to you. Okay. Uh, okay, Hardik is saying, can you please go down? How do you calculate the capital profit? So if I go down this one you are saying. So is this the one? Okay, so Nitin is saying point G is given on page 10.139. All right, so let me just go to page 10.139. Here again, I can't see that. So maybe you're referring to some other document. Maybe we can just deal with that later. As of now, I think you had one more question. So what I'll do is I'll just get on to that question now. Okay, so looking at this question number 5. So I think now for the reference of everyone, so this question was asked, and I think this was from MTP. Okay, so I have looked through this question. Maybe if you can just, if you want to refer everyone, you can just refer this question. This was from MTV, question number 5. Okay, so in this question, I think Hardik was facing some challenge as around the calculation of purchase consideration, preference share capital part. Okay, now if you look at the requirement of the question says preference shareholders are paid by paying 15% premium. Okay, so what does it mean? That if the preference share capital was 5 lakh, so they will be paid 5 lakh 75,000. Okay, so they will be paid 5 lakh 75,000. Now, these preference shares were having a coupon rate of 8%. So the question further said that the settlement to the preference shareholder should be done in a manner that they will continue to get the same amount of preference dividend. Okay. So therefore, what do? You will have to give them those many preference shares so that their preference dividend remains same. So on 5 lakh, what is going to be the amount of preference dividend? If you compute it at 8%, on 5 lakh, what is going to be the amount of preference dividend? Quickly, 40,000. Yeah. Okay. So now on 10%, if you issue preference shares at 10%, now let me just come to this part. I think these are the accounting entries. Now, if you give them preference shares which are carrying a coupon rate of 10%, okay, so it would mean that by giving shares worth of 4 lakh, they will get the same amount of preference dividend. Yes or no? Now, what is the amount of preference shareholders which needs to be paid? 5 lakh plus 75,000. So 5 lakh 75,000 is required to be paid to them. So how do you pay them? All in all, the amount will be 5 lakh 75,000. How do you pay them? 4 lakh, you will pay them through preference share capital. So new preference share capital will be issued at 10% coupon rate. So thereby what will happen? They will be entitled to the same amount of preference dividend. And the remaining amount that you will pay to them will be in the form of security premium. So this entire amount, the balance amount, you will take it to security premium. Okay. So the same thing is done in the solution also. Yeah. Appears to be slightly tricky, huh? Of course, wherein you may have got stuck. And if you look at the balance sheet, okay, so in the question, I think they have also produced the balance sheet. So everything is given. Huh? So if you go look at the balance sheet, so the preference share capital becomes 10 lakhs. Why? Because 6 lakh is that of the transferee and 4 lakh is that of the transferor. Correct, Hardik? And if you go look at the reserves, in the reserves, what do you have? Security premium of 1,75,000 getting added. Clear? Are they clear on this now? Then I can see this other query from Sania. She is asking, sir, 9N, page 10.157. Okay, let me just try. So you are referring to some of the documents. 157. Okay, so 9n. Yeah. So I am on this page number 10.157, 9n. So I believe that all of you are referring to some other documents. Huh? I would advise that please go refer the latest study material which is available on the portal. Huh? If you are planning to quote something. Otherwise, it will be very, very difficult. Huh? So I don't see anything 9n. A point G. So Kasak says no problem, sir. On this page, if you can just explain point G. Okay, so let me just look at the header. Huh? So what is this header? So what is this? So this is about proportionate consolidation method. Okay. So point G, on the date when the interest in joint entity is acquired, if the interest of the venturer in net assets of the entity is less than the cost of investment, the difference will be recognized as goodwill. And if the net asset is more than, so this is all about goodwill or capital. So the same thing that we have discussed in case of holding, subsidiary, and associates. Okay, so the same concept you have in case of JV also means JCE, but at your level, I don't see these questions coming up. Huh? Why? Because these have not been captured like this. Yeah. But of course, this concept exists. So that's the point. Okay. So if you pay consideration in excess, what do you have? Goodwill. If you pay consideration in short, you'll call it as capital. So that's the point. As simple as that. Clear? Okay. Yeah. So are we through with this? Clear? Everyone? Through? Okay. Tambeshwari says 10.105. I think the pages are starting from 10.135 only. I think you are just referring to some other topic. Huh? So I would suggest Tambeshwari, you can just conceptual query if you are having, then of course we can discuss. Otherwise, I have to just go through that complete question. Huh? So time is too short. Will not be able to do that. Huh? Malu is asking, sir, how to identify the question of. See, this will not be mentioned to in the question. So every time you'll have to understand the structuring. Means how are they structured? So is it a case of JCO, JCA or JCE? For which we have discussed. Yeah, for which we have discussed. You need to understand that. And accordingly, you will take the call. Huh? Yeah, so some of these examples we discussed. Why did we discuss these examples? To make you understand that what will be a scenario of JCO, what will be a scenario of JCA, or what will be a scenario of JCE. And that is also something which is given in the study material as a difference also. We tried to summarize that also. So that's how you will take it. Okay, clear, Malu? Yeah. So I think we can just close our discussion now. I understand some of these questions, but see, when it comes to those illustrations, it's very difficult to get on to those illustrations. Just read them completely and then answer your question. Yeah, so time is too short. Yeah, maybe you can just send across these queries and we can just try to come back to you on this. Okay, so you can just feel free to BOS. You can just send across your queries, and therein all of those queries should be answered. Yeah, okay. So I think with this, we can just conclude our discussion. Thanks once again for this time and for this wonderful participation. I would suggest that please revise these topics. These are very important. Huh? Okay, from examination perspective only, right? So thanks everyone. Thanks so much. Done, Manish. Thanks.